Well, welcome back. Well, stocks kicking off the new year on a positive note after ending 2025 with a third straight year of double-digit gains, driven largely by President Trump's agenda and optimism around artificial intelligence. The momentum on full display yesterday, NVIDIA CEO Jensen Huang unveiling the next generation chip, the Vera Rubin superchip, along with new AI tools for robotaxis and robotics. The focus is not just on tech, though. Two major policy decisions that we are all waiting for, watching closely, include the upcoming Supreme Court decision on President Trump's use of tariffs in an emergency and the president's choice for the next chairman of the Federal Reserve. President Trump pushing an affordability agenda, promising the largest tax refunds ever this year. And Goldman Sachs says it expects the economy to accelerate, with GDP growth picking up to around 2.6%. Some economists even higher than that. Joining me now is the Bear Traps Report founder, Larry McDonald. Larry, great to see you.
Maria, thanks for having us.
Happy New Year to you.
Happy New Year.
What are you looking at in terms of your expectations to drive markets in the year?
Well, a year ago today, and you've been so helpful around the hard asset story, right? The market capitalization of gold and silver a year ago today was 19 trillion. Now we're up to 35 trillion.
Wow.
And what's happening?
Just gold and silver?
Just gold and silver.
35 trillion.
And that's just the metals. So what's happening is, the big macro story is, since 2022, we've had a lot of government spending globally. And anybody that's in government bonds in Japan, the United Kingdom, United States, Italy, everyone's losing money since 2022. And that's driving capital into hard assets.
All right. So what other hard assets do you think will catch a bid? I mean, beyond gold and silver, do you like the whole commodity space?
Yes, typically the mothership moves first, your gold and your silver. Then you've had this move into platinum and palladium. But now we're starting to see companies like industrials that own that own metals and commodities. Those types of stocks are starting to outperform the NASDAQ. So your industrials, and then last year, your global value industrials, they were double the S&P. So this is a big trend shift. And in our ideas dinner in Palm Beach at the end of the year, the one thing that billionaire investors were pointing out to me is that when you see that kind of move, it's never a one-year thing. It's always a 5, 6, 7-year thing.
Wow, that's awesome. And oil as well, I guess. Yeah,
oil services, I mean, you're talking about the underperformance of Schlumberger and Weatherford and these oil service companies. The underperformance versus the rest of the energy complex has been spectacular over the last decade. And once again, we're seeing a colossal shift the last month into oil services away from the rest of the energy complex.
Yeah.
So people are rebalancing, and all that means is you can buy Schlumberger today below or near its 200-month moving average. Think about that. So you're talking about a vicious, bombed-out village, like just long bear market. It reminds me of uranium stocks in 2020-21.
Yeah, but do I want to do that over putting my money in AI-related companies? I want to get your take on the macro story. What are you laughing at?
Jensen is the pump master. I mean, this guy was pumping AI chips now, but it was metaverse chips before.
Stock's up 100+%.
Yeah, but remember, NVIDIA's had like 3 drawdowns since 2018 of like 60, 70%, right? So he tends to overpump the high. And right now, there's 32 trillion in the NASDAQ 100, 32 trillion. 3 years ago today, 12 trillion.
Wow. Yeah, well, that's what's done the leadership in this market. But I'm going to get your take on the macro story, because we are right now at the beginning of earnings season next week. The major banks will kick off the earnings season, putting the spotlight on financials. Financials have been doing better. And Larry, you're short JP Morgan, Citi, you're long coal and natural gas. I know this. But what's driving the call to be short the banks?
It's not just the defaults that we're seeing in auto lending, right? It's the banks are massively exposed to what we call AI data centers, right? So the street expects 830 data centers to be built over the next 5 years. And there's all kinds of financing for that. Now, if you look at CoreWeave and all these different financing vehicles, they're yielding like 11%. In other words, there's like this mini credit crisis that's forming, and that's because of NIMBY.
Not in my backyard.
Not in my backyard. Now, if you look on Google in terms of NIMBY, the searches are up a lot. All that means is people are starting to say, okay, I don't know about 835 data centers, because probably 200 of those might be NIMBY victims. And what that means is the growth expectations for AI implementation come down, and that means there's a lot of bad loans in AI.
So you think the banks are going to be on the hook for the loans for the data centers?
Yes. And private credit as well. It's like two punches coming at the banks at the same time.
But what about if the macro story improves? I mean, I talked to Louis Navalier here. He was in your seat last week, and he's talking about 5% GDP growth.
Right.
Here he is. Watch. What is your assessment of the macro story? How do you want to be invested in 2026, Louis?
We're going to hit 5% GDP growth. We're running 3.5 to 3.8 now, but they're going to be revising it up because the trade numbers, the trade deficit's the lowest in 5 years. The exports the second highest ever recorded with low oil prices. So that's going to big upward revisions. Obviously, a lot of the growth was onshoring, but even and the data centers. But if you look at the data centers, their order backlogs are up 20% quarter over quarter. So we're going to enter the new year with we're going to hit 5% GDP growth.
I mean, that is a big number. And, of course, it comes off of that third quarter real GDP of 4.3%. But you think that this is all a promise and the data centers' loans will default?
Yes.
And the banks will be holding the
bag. A lot
bag.
of times, every credit crisis the last 20 years has really come out of a hot economy, right? In other words, where lending standards get so stupid and so ridiculous, right, that bad loans are out there. Private credit, one of the things that's coming out of our ideas dinners that we've been running around the country is private credit's like $1.8 trillion, but almost $300 billion of that has promised financial advisors watching us right now quarterly liquidity. Think about that. So you're promising an asset class that's very difficult to raise capital in private credit when you have to sell things, right? So a lot of things, you know, the old when I sat down with Charlie Munger years ago, he said it's mark to market, mark to model, and mark to myth. And so if you offer quarterly liquidity on an asset class like private credit, that's another genesis for a credit problem.
Wow. All right. So this year you want to be long hard assets. And
yes.
The companies that are benefiting from those hard assets,
yes.
like the oil companies that are benefiting or the gold companies or silver.
Yes, and the banks, you're owning J.P. Morgan at 2.3 times book here. That's ridiculous. Remember, Buffett's selling the banks aggressively, selling his Bank of America. Jamie Dimon is selling his personal shares of J.P. Morgan at the fastest pace ever. Now,
Even if we have a big IPO boom.
Well, that'll help the first quarter of this year. They'll give you some love, but a lot of that's priced in at 2.3 times book on J.P. Morgan.
All right, I could talk about this all day, Larry. Great to have you. Thanks very much. This is a really important analysis, and I'm glad you brought up the loans on the data center. Thank you so much. Good to see you.